You're watching Magnetic Media News Network. I'm Mia Kudos. This is Behind the Headlines. Because what matters isn't only what happened, it's what happens next. Let's begin. What happened? The Federal Reserve held US interest rates steady at a range of 3.5% to 3.75% during its latest meeting, marking the first decision under new leadership. The Fed's rate-setting committee was split on whether to keep rates steady or increase them to combat inflation, which currently stands at 3.8%. The decision was unanimous, however, reflecting heightened uncertainty tied to geopolitical tensions, particularly the conflict in the Middle East and its impact on energy prices. The Fed's statement was notably concise, reflecting a shift in communication style aimed at reducing forward-looking guidance. 9 of the 18 central bankers projected a potential rate hike later this year, while only one anticipated a cut. Who does it affect? This decision directly impacts borrowers, investors, and businesses navigating the US economy. For borrowers, steady rates mean no immediate relief on loans, mortgages, or credit card debt, which remain costly. Businesses, particularly those reliant on borrowing for expansion or operations, face continued pressure to manage financing costs. Investors, especially in bond markets, must recalibrate expectations, as the Fed's signal of potential rate hikes later this year could lead to volatility. Consumers, too, feel the pinch as inflation remains above the Fed's target, eroding purchasing power. The uncertainty surrounding geopolitical tensions, such as the conflict in the Middle East, adds another layer of complexity, particularly for industries sensitive to energy prices, like transportation and manufacturing. Even global markets are affected, as the Fed's decisions often set the tone for central banks worldwide. What should we watch next? First, keep a close eye on the Fed's next moves. The central bank's projections suggest a potential rate hike later this year, but this is far from certain. Inflation trends will be critical if price increases persist. The Fed may feel compelled to act, but if inflation cools, rates could remain steady. Second, monitor geopolitical developments, particularly in the Middle East. Any escalation or de-escalation could directly impact energy prices, which are a key driver of inflation. Third, watch the US labor market. The Fed's statement noted that job gains have kept pace with workforce growth, but any signs of weakness could shift the central bank's calculus. Finally, pay attention to global central banks. If the Fed signals a more hawkish stance, other central banks may follow suit, leading to tighter financial conditions worldwide. Smart money. Neutral. Smart money is adopting a cautious stance, recognizing both the risks and opportunities in the current environment. The Fed's decision to hold rates steady reflects a delicate balancing act tackling inflation without stifling economic growth. However, the signal of potential rate hikes later this year introduces uncertainty, particularly for bond markets, where yields could rise in anticipation. Smart money is also watching geopolitical risks closely, as any disruption in energy supplies could reignite inflationary pressures. For now, the focus is on diversification, with an emphasis on assets that can weather volatility, such as high-quality bonds and defensive stocks. The Fed's new communication style, which reduces forward guidance, also means smart money will rely more on data and less on central bank signals, making economic indicators like inflation reports and jobs data even more critical. That is what sits behind today's headlines. Thank you for joining us for Behind the Headlines. Until next time, stay informed, stay ahead. And if you haven't already, subscribe for more intelligent analysis Monday to Friday.